We are live on both sides, Mr. D. You wanna do the introduction today?
Action. What's up, fellow hustlers? My name is Diane.
And I'm Curtis.
And in today's installment of our SMC series, we'll be focusing on Chapter 3.
This is liquidity. For those who didn't catch up to the first three parts, we covered what is SMC, and the second basically was what is market structure. And today we're covering liquidity. So liquidity is a very big section in trading as a whole, because it basically tells you where bundle of orders are on a specific level. In the book it tells us what is liquidity, and we'll just continue the series. So yeah. So if you're new, make sure to subscribe, and also make sure to leave a like if you're enjoying the series so far. So I guess we'll just get into it, Mr. D.
Yes, follow along.
There we go. Get your pens, because you can draw it out.
Alright,
so here we go.
Liquidity.
I'll start. Okay.
What is liquidity? Liquidity refers to how easily an asset can be bought or sold. Liquidity is everywhere on the market, and it fuels the price to move up or down. Without the market can't move. Okay, let's say without liquidity, market can't move.
Yeah. Okay, that's...
Let's do something there. Just like with a car, if it doesn't have fuel or electricity, you will not be able to use it.
Okay. How can we spot liquidity? Liquidity is simply the totality of orders that we have on the market. This could be the TP, your stop loss, limit orders, stop orders. This generate a lot of big moves, because most of the time price takes the liquidity and then goes straight to the other way. This is what people call a trap. Okay, forgot the A. We have a common models to be able to spot liquidity on the market. So we basically cover the models of how to spot liquidity in them.
Liquidity common models.
Yeah.
As said earlier, the price will use the liquidity to make the opposite moves. In fact, if you are bearish, price creates equal highs. Above those equals, there are sellers, stop loss, breakout, traders, stop orders,
limit
orders on the pullback. This creates large number of buy orders, and those will allow the big players to sell the market with the amount of money trapping in this way. Okay, so our big players is probably our banks
and financial institutions.
Yeah,
obviously.
this way. The majority of the traders, even the ones that are following the trend, can be swept before price stops.
So that is just theory. Once again, pause and read it again, and then we'll just move on to the models. So this is the first model, which is your equal high, and abbreviation EQH model. So as you can see, let's just zoom in. So there we got a equal high. So from our experience, it's better to draw it out, because as you can see now, you can basically visualize how seeing it, but later on when you actually look at a chart, if you don't have the book, it's going to be difficult to cross-reference. Where we have the book, and we basically can just look at this equal high pattern and just match it to when we see a similar setup on the chart. So it's best to draw it out and have it down a few times before going on to the next liquidity model, which is, this is the first one. As we can see, equal high. So here we can see basically just two similar equal highs, and then price basically consolidate for a while, and this is where liquidity is. This red dot here is the equal high liquidity, which is your stop loss, limit orders, and so on. So this is a potential model for your equal high. Then if we go just some price, here's some boards. Price can move a lot before it sweeps the liquidity. It's not something that happens in a minute. Yeah, it takes time. All structure building up after the equal high will be used as liquidity. So this here, as you can see, all structure after basically is used as liquidity. So what we just saw here for the equal high, this is just your equal low. So once again, draw this out and have it down on the paper, and draw it as much as you can, and do the exact same for the equal low. As you can see here, this is basically equal high. This is the core part, I would say, for the equal high here. You can see double, and then here for the equal low is this point here. So you can see the differences between the two.
It's your way of identifying the chart, basically.
Yeah. Equal low. So here once again, this is your equal low. You have your equal low at the bottom, consolidate. So here is your sweep of liquidity, which is there's a lot of orders, your stop orders and limit orders. So basically where a lot of action or a lot of price will build up on a specific trend. So you can see there's a lot of people trying to maybe have limit orders here, buy orders, sell orders, because you're not depending on what
I'd say that's
is.
where most of the stop losses are.
Stop losses are, yeah.
Because then that's when you get that's when banks or the big players, basically our chart movers, would look to liquidate us small traders. So that's where all the stop losses would basically be sitting.
Yeah. So far we've identified two models, which is your equal high and equal low. So write it down, have a visual representation of it. So here is just your equal high in chart form and not line form. So this is how it will actually look on the chart. So let's just zoom in. As we can see here, just your red goes down, creates equal highs. You can see it's very small. So this is how it will look equal high, just long wicks, as we can see here. So these wicks are equal high wicks. Here it creates your break of structure. If we zoom out again, there's your sweep of liquidity. So it goes up, has a lot of here you can see stop losses, limit orders, and then it sweeps basically a lot of people, creating a downside liquidity pattern here. Here we got your equal low. So it's basically the same equal highs we saw here on top. Equal lows. Here's your equal lows here at the bottom, creates that pattern. Here's your stop losses, your liquidity, and basically it sweeps out all the peoples and goes up, creating the big move. So the next pattern is your structure high model. So we've identified two so far. This is the third liquidity model, which is your structure high. So the structure high model is a very powerful because it must lead a lot of people in the term of switching the structure. So okay, hope you got that one down. So here we have your structure high. Basically it comes as a downtrend, so it's basically it comes down, so it's basically a bearish liquidity trap. So here we have your structure high. Basically it comes here, creates a lower low, comes back up, creates a just consolidation, making it way up back to the structure high. So this is where your liquidity is, basically testing this structure high again. You have your stop losses, your limit orders, and basically sweeps out people. Structure high. So I would always tend to throw it out again if you look at the two similarities between the other ones on top we just mentioned, which is, you can see there's not a lot of similarity between this one, but we did see the momentum shift and the momentum shift and the structure low, for example. Structure high has like similarities between the two, but you'll just see it as we go on. So there we have your structure high pattern or structure high model, liquidity model. As you can see, there's that. Just write it down or throw it out again. And this is basically your structure low.
Which is just reversed.
Which is just reversed, yeah. So it basically, this is an uptrend. It creates, here's your high, creates a high low. Basically, it creates a high. So this is your structure low here at the bottom.
And on the pullback,
or your swing low. It could be another term. Could be your swing low.
Like on the pullback, it looks like it's now switching over to a bearish.
A bearish, yeah.
Yeah, before it switches back up to bullish. And there you get liquidized and boof, there all your money go.
100%. So yeah, just identifying your stop losses, this line here. So you could, if you see this in the chart, you can like maybe throw a line. This is potential liquidity, where you can see a lot of people has orders. So this is the exact same, just in chart form once again.
The examples now.
Yeah, you have your BOS, your BOS. Here you have your structure low. So if you had to do it like here, you have your high, high, low. This is when you identify your market structure first. And then once it comes, this is like kind of a complex pullback in this regard, and then basically test
this was after the complex pullback. After the pullback.
And then it basically has your stop loss where there's a lot of liquidity, and then structure high. So that is your structure low, structure high, basically the same. Basically this is on a bearish model. There we go, creates that, creates the consolidation, it comes in and basically liquidates people on this thing. So far we have your equal high, you have your equal low, structure high, and structure low. That's the models we have so far.
Momentum shift.
So this is your sixth liquidity model, which is a momentum shift. You can see there's a little bit more to it. It's kind of almost the same as your equal high, equal low. Just the momentum shift is a little bit higher. As you can see this one here. This one basically not touching full part where it would have been a equal low or equal high.
I'd say it looks similar to an equal low.
Equal low, yeah.
But now it's just most obviously now the two.
It's a shift. As you can see, there's like a momentum shift in this part. So once again, pause the video, throw this out for yourself, and then just have it like that, because we don't have, none of us, I don't think a lot of people have photographic memory. The word, not a lot of people do. So yeah, I think best to draw it out and then memorize it like that. So momentum shift, once again, comes down, creates a short shift, goes up, consolidate, complex pullback once again here, comes test to liquidation. So there's a lot of orders in this momentum shift right here. So this is the bearish model, and this is the bullish model. So this is the only difference right here. So the momentum shift is down, momentum shift is up, as we can see that part there. Once again, creates a consolidation or complex pullback, comes back to the test and liquidate a lot of people.
See, like it looks like they're counterparts also.
Counterparts. So these two are counterparts, similar to how the equal high and equal low is on top, as we can see here. So yeah, equal high is equal low, and then equal high, so basically counterpart to that. If we go on, next we got, okay, this is just like the chart form, just have it visualized. You can see there.
the examples.
Examples of it, this is how we will look. Here's your equal momentum shift, and there would be your stop loss or your liquidation, limit orders, there's a lot of people put their buy orders and stop losses and so. This is like a high demanding price. Same thing for your momentum shift bullish chart, as you can see there, it goes down. Next one is your trendline liquidity bearish model. So this is your 7 liquidity model. So the difference here with this one is basically it creates a series of lower lows or higher highs at the start. Since this is a bearish model, it creates lower lows and low highs, as you can see there.
And it creates a trend.
It creates a trend now, which is the
That's
word.
the name.
Trendline liquidity. So yep, so you can see there high highs, high lows, breaks, come back, make a BOS, comes back to the top where the trend line started basically. So this is where a lot of stop losses and so is. Basically, this is where you can lose a lot of money. Right here, when you think that you will assume the trend has changed, it may a change of character at this point, and basically it liquidates people because it's following a large pool.
The first change, you know, help me with the mouse.
No, the mouse.
I can't show you with my finger.
Where is it? Where?
Yeah, give me the mouse. Give me the mouse. Give me the mouse. Right here.
Yeah.
Right here. The first change is when the banks would first this is your first stop loss.
To show you your first stop loss, yeah.
This is your first stop loss, and I think this is where banks would first look to liquidize you, both maybe, and then they would get those people that are just careful but not careful enough. You know. Oh shit. Yeah.
Okay. So the next one, you can someone go to the next one. Next one, we got the trend line liquidity bullish model. So once again, it's the exact opposite of the bearish model, but it basically creates a series of high highs. So the bullish is basically it goes up, and the bearish, maybe just go to the bearish again. It's basically just down. So as you can see, so if you look at, try to remember the bearish, just remember it's down towards the end, it's down, which is that there, and then the bullish is basically it's a bullish trend on the output. So you can see trend line liquidity. So that is so far we have identified 6 models of liquidity.
Yeah, and then these are the examples.
These are the chart examples here, you can see. So once you can also back test, maybe look at the chart and back test it from that point on. Throw it out.
I know we are moving at quite a pace.
Yep.
Yes.
And we can always come back to this book if we lost something or forgot something. So we can come cross reference. So
liquidity types.
Yeah.
It is important to distinguish liquidity in 2 types.
Okay, yeah.
In fact, the liquidity itself refers to the global liquidity of the market. The difference resides between the buy side liquidity and the sell side liquidity.
Yeah.
Yes.
You can't have a buy without a seller, and you can't have a seller without a buyer. Yeah.
Fucking bars.
Okay, the buy side liquidity, BSL, so you can see there's like a turnbuckle, we'll get to that. The buy side liquidity is basically all the liquidity that will be used by the buyers. It creates a major buy sell order, but then it can also be buy orders as seller stop loss. Okay, that's
basically this.
Yeah, basically that. Buy side liquidity, sell orders. So basically buy orders, basically sell orders, stop losses. What that first one is telling me there on top now, the wording. So you can see there is a...
This is the tug of war section.
Tug of war, yeah, basically.
This is the tug of war section. This is where all the fighting is happening.
Yes.
Yes. This is the buyers and the sellers doing their thing. Doing their thing.
Okay, what's the next part? As you can see, when we are on a bullish market, price will likely use the buy side liquidity to allow the next bullish move. In fact, to have a big bullish move, the price needs sell orders to generate more liquidity. Also, the buy orders of the stop losses will generate more buy orders, and that's why when a breakout happens on the market, the price gives an impulsive or big or not, depending on what the price has to do next. Okay.
Sell side liquidity. The sell side liquidity is basically all the liquidity that will be used by the sellers. It creates in major by buy orders, but can also be sell orders as buyer stop loss.
On that side. Go to the top one just to see the differences between the two. Basically, just towards the end of it, yeah. Yeah, the end of it, basically.
Here's the buy side.
Okay.
Here's the sell side.
Oh, yeah.
And then just opposite.
Let's go around a little bit. Okay, a little bit more inner. Let's say. Oh, shit. Okay, I think that should be enough.
As we can see, when we are on a bearish market, price will likely use the sell liquidity to allow the bearish move. Yes, so you remember bearish coming down. Yes. In fact, to have a big bearish move, the price needs to buy orders to generate more liquidity. Also, the sell orders of the stop loss will generate more buy orders, and that's why when a breakout happens on the market, the price gives an impulsion.
Big or not. So it's basically the exact opposite of what we just saw on sell side liquidity.
Let's see how implement both blah 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 liquidity bullish market.
Just zoom out a little bit.
Okay,
here we go. Understanding liquidity bullish. So this is what we kind of just saw now. More a lot of wording.
Yes.
Okay, on the bullish market, we understand now how the BSL buy side liquidity can be helpful in our trade. But what happens about the sell side liquidity then? The SSL in a bullish market will be useful to trap people and induce them to make the wrong move. In fact, once the SSL or the sell side liquidity is broken, it induces a breakout traders and creates also supply zone for SMC traders. So there's now basically you have your breakout traders, but we SMC traders at that point. So SMC traders, if you don't spot the structure and liquidity in the right way, you could become the liquidity of someone who follows well the market. To summarize, always said for now, the bullish market. In a bullish market, the SSL will be employed to trap and induce people towards the wrong move. The buy side liquidity will be used by the price to generate a big move, basically. Okay. So understanding liquidity bearish. So it's kind of the exact opposite of what we just said on top, basically.
Yes. On a bearish market, we understand now how the sell side liquidity can be helpful in order to trade. But what about the buy side liquidity then? What about it?
Yeah.
The buy side liquidity in a bearish market will be useful to trap people and to induce them towards the wrong move. Yeah, they're trapping us, man. We have been trapped.
We have been trapped so far.
In fact, yes, indeed. In fact, once the buy side liquidity is broken, it induces breakout traders and creates also a demand zone for SMC traders. And if you don't spot the structure and liquidity well, you could become the liquidity of someone who follows well the market.
Yeah, it's basically the exact opposite.
You guys cut off. The liquidity is a very important concept. More and more in the market, it induces a lot of people to make the wrong move, and you must be very careful to several traps.
So I would say liquidity is the master of deceive, or master of traps.
Master of deception?
Master of deception.
Yes.
Lovely.
Yes.
External range liquidity, which is the last liquidity model. So far we've identified 8, so this is the 9th one, which is external range liquidity. So this one, if Mr. D just scroll down, it looks a lot. It looks like a lot is happening. Let's zoom out a little bit. Oh yeah, there we go. So let's start maybe at the top. We start external range liquidity. As we know with the structure, on a bearish market, the high is protected, and vice versa on a bullish market. We can understand that there are a lot of orders above or below those protected structures. So they, like we've seen now, multiple trends. You have when your lower lows and your lower highs, basically, or your change of characters of that specific points that we can see.
Structure, break the structure.
Your sell side liquidity. So that is what that means. As you can see, once price sweeps the external range liquidity ERL, a lot of liquidity is swept. A lot of people are induced to make the change of the structure, and during the bullish leg that was created to come back to the protected high, price creates even more liquidity with all the buyers stop losses. We will see the next page a bullish example on the real market directly. So it will show us an actual example.
Here we are.
So there is external range liquidity. So I think this is where you should pause this video and throw this out and have a clear understanding of this. So yeah.
Pause right here. Throw it out right here.
I say.
Yes.
So the next step is, as we can see on this chart, price was in a bullish trend, breaking higher highs and higher lows. At some point, price started to lose its power and started a pullback. So where's that pullback? Maybe just identify the pullback. Oh, there is it. High highs, there's a high. Creates a pullback. Okay. It breaks the first structural level and makes a change of character. So so there's that change of character. So in the pullback leg, we can see a lot of momentum that also induces even more people to create sell orders when price will pull back, basically. So that point there at the bottom, So after the change of character, price sweeps the protected low, which is a external range, and directly reacted from the given very nice bullish leg that takes out every seller. So the people that basically tried to sell at that point got swept out basically at that point.
Yes.
Then the basic liquidity that you got on your chart is the range, and you are trading can be called internal range liquidity, IRL. Okay. Liquidity model, BSL, SSL, RL, so that is a lot of terms, so make sure you get used to that. But why does price need to sweep liquidity? There are more than one reason. To induce people to make the wrong move, to take out people, that can be cause of imbalance. Okay, so that is the main reason for liquidity.
The
imbalance.
Ooh. I need to zoom in my eyes. When price moves, suddenly it leaves big candles. Between those big candles we have big gaps.
Yeah.
Those gaps are orders, basically liquidity.
Price
just can't move in one side. There we go. One side by leaving a lot of imbalances. As you know, when you set an order, a sell, for example, you need a buyer in return. If the price always moves in a bearish trend, no one will buy and no seller will make money. Very true. Understanding that we can see a market with a lot of imbalance as inefficient, and a market without imbalance as efficient. On an inefficient market, price will need to rebalance itself.
So it's kind of like a fair value gap, if I had to say.
Yeah, it is a fair value gap.
Yeah, it is a fair
value gap.
Yeah, at that point.
They just, there's just a different name.
Different name for it, yeah. So like our demand zone, the order block is the exact same name. So it's basically just a fair value gap, which I think the book will cover it later on. But yeah,
yes. Price will not necessarily come back on the imbalance as fast as the graphic above. Sometimes it takes 2 minutes, sometimes it takes days. It does. I know that. It also depends on the time frame you're trading. Yes, very important as well. And we are done.
Chapter 3. So firstly, we rushed through this book because it takes more time to firstly write down and memorize each of the patterns. So if I bet you we had to go up, we'll not fully know it, but that's where you write it down and try to memorize each of these patterns, because even though briefly going over like this won't get you to that point where you memorize it by like heart. So I think watch it a few times just to get all of them and throw it out, I would say. So that once you identify, like type all the 9 models, you should have liquidity, a little bit more understanding of it. So yeah, I think that covers today's video. I think we covered everything. Like I said, just go back to the video, watch it as many times as you need, make your own notes with regards to liquidity. And in the next chapter, we'll be going over supply and demand. We have mentioned this term, order blocks, supply and demand, your demand zone. I think Mr. D covered this in his video. So this is also a big topic in SMC trading. So this will be chapter 4.
And if you are joining us for the first time today, please make sure to check out our other videos that we have on the chapter, on the book. Sorry.
So far we have, this is the 3rd one. We have 2 prior to this, so make sure to check that out.
And if you're feeling just a little bit more generous, check my video out as well.
Yeah.
Yes. My solo.
A wise man once told me, up the Swiss.
Up the Swiss!
Yes, so
it was a good trade.
Yeah, it was a good trade, but yeah. So I think that wraps up today's video. So like we already said, make sure to like and subscribe, and we'll check you in chapter 4. I'm Curtis Bodies.
And I'm...
Until next out, peace out guys.